All right, Steve here. For a while now, we've been talking all about offense, how to attack the market, how to collect those premiums. But today, the market is giving us a harsh reminder that it can take back every single thing it gives. So we're shifting gears. Today is all about defense. We're going to talk about protective calls and protective puts.
Just look at the calendar. It's Monday, March 9th, and it is a rough one out there, believe me. This isn't some theoretical lesson for another day. No, this is about protecting your hard-earned capital right now, today.
Yeah, the S&P is down 90 points already this morning. When you see that much red on the screen, man, it hurts. It's a real gut punch, and it's a stark reminder that this thing does not just go up. So that brings me to a very direct question for you. Is your portfolio insured? I mean, really, think about it. On Schwab, these protective options, they are your insurance policies. You pay a premium, hoping you never have to use it, but man, you are glad it's there when you see nothing but red. All right, let's get into it.
Okay, first up, let's talk about the most common situation. I'm guessing most of you out there have a long portfolio, right? You own stocks you believe in for the long haul. Well, this is how you protect that portfolio from a serious drop. This is the protective put.
So, what exactly is it? Think of a protective put as your emergency brake. It's how you stop the bleeding. It's simple, really. For every 100 shares of a stock you own, you buy one put option contract. And the whole point? Well, if the stock takes a nosedive, your put option starts gaining value, and that helps cancel out the losses from your shares.
And the process couldn't be more straightforward. Step 1, you own the stock. Step 2, you buy the put. That's it. Just like that, you've drawn a line in the sand. You've basically set a minimum price, a floor, for your stock.
And that really is the key benefit here. It's a floor. See, that put option gives you the right, but not the obligation, that's important, to sell your stock at a specific price. We call that the strike price. And you can sell it at that price no matter how far the market tanks. It's about paying a little bit now so you don't lose the whole farm later.
Now, here's a practical tip. When you're on the Schwab platform, what you pay for this option, it's going to show up as a net debit. And I want you to think of that debit as something else. That's the price you pay for peace of mind. All right, let's flip the script now. Let's talk about the other side of the trade. This next one is for the bears out there. The folks who are shorting stocks. You guys face a totally different kind of risk. And this is your shield. This is the protective call.
So the idea here is basically the exact opposite of the put. You're short 100 shares because you're betting the price is going to go down. To protect yourself from being wrong, you buy one call option. Why? Because if that stock suddenly rips higher against you, that call option is going to be your lifesaver.
And let me be crystal clear about why this is so important. When you buy a stock, the most you can lose is what you paid for it, right? It can only go to zero. But when you short a stock, your risk is unlimited. There's no ceiling. A stock can, theoretically, go up forever. That's a dangerous game to play unprotected. This is where the protective call is a total game changer. It puts a ceiling on your potential loss, it caps your exit price, so if the stock just rockets to the moon, you simply exercise your call, buy the shares back at that fixed strike price, and you close out your short position. And just like that, you've turned a trade with unlimited risk into one with defined, manageable risk.
Okay, let's talk about how to actually apply this. Here's the pro tip, and it's a big one. You have to find the right balance. It's all about cost versus coverage. You're trying to find that sweet spot.
The best way to think about this is like car insurance. It really is. You have to pick your deductible, right? Are you going to get the expensive plan with a low deductible that covers every little ding and scratch? Or are you going to get the cheaper plan with a high deductible that's really just there to protect you from a total catastrophe?
And this table here lays it all out. A low deductible insurance plan, well, that's like picking a strike price that's really close to the current stock price. It's going to be more expensive for sure, but it protects you even from the small dips. On the other hand, a high deductible plan, that's a strike price way far away from the stock price. It's going to be a lot cheaper, but it's really only there to save you from a complete and total collapse.
And you know what? The exact same logic applies to time. When you're looking at the option chain on Schwab, you see that days to expiration column. Use it wisely. If you're just worried about an earnings report that's coming out this week, why in the world would you buy 6 months worth of insurance? It makes no sense. Figure out your risk, buy exactly what you need, and not a day more.
All right, let's wrap this up. Let's get to the bottom line here. Because after all the charts, all the strategies, all the talk, it all boils down to one simple fundamental rule of survival in this game.
And it's this. Remember this. Trading isn't just about how much money you can make. It's about how much money you can keep. It's not about the good days. It's about surviving the bad ones. And these protective strategies, this is how you make sure you're still standing when the storm passes.
So I'll leave you with this question. Are you ready to protect your capital? This is Steve. Stay sharp out there, and I'll see you at the open.